With us Vijay Rajendran today. I've been hearing Vijay at various conferences, RISE and CIS and around the world, and was super delighted when he agreed to be with us for Ideas 2020. Vijay heads up startup growth at 500 startups. I'll let Vijay introduce 500 startups, which you may all be well aware of, one of the world's top accelerators and investment companies. But about Vijay, before we jump into the session, Vijay brings a truly unique perspective, not just to innovation, but I think to the world at large. So super thrilled to have you, Vijay. Vijay is author of Unlocking Corporate Venture Capital, author of Corporate Startup Experiments, went to Georgetown, did a master's there in foreign service, spent actually before that 2 years in Cameroon with the Peace Corps, did his MBA and did in a multiple startups, multiple corporate roles, and now with 500 startups, and here we are today. So welcome, Vijay. Privileged to have you. I'd like to hand this over to you. Over to you, Vijay.
Thank you, Navyug, for that very kind and generous introduction. Thank you, everyone, for joining us today for day 2 of Ideas 2021. It's a great pleasure and honor to be with you all and to represent 500 startups. And when Navyug and the organizers of this conference, extended an invitation to me, I was just delighted to attend and really appreciate the opportunity. So today, what I hope to do is share with you a perspective on corporate startup innovation from 500 startups, and to be able to walk you through a little bit of what we're seeing in the world and why I think there's a very exciting time for us to be able to go on this journey of corporate startup innovation. So a few signposts for our conversation here. I'll be taking some time to give a little bit of introduction to 500. I'm going to talk about why it's so important to collaborate between corporations and startups, discuss some key trends that we're seeing around the world from our work, and then finally some takeaways and for business and some discussion at the end between myself and Navyug. So about 500, something that's worth knowing about us is that we are the most active venture capital firm in the world globally. Today, we have more than 2,400 portfolio companies in 77 countries around the world, which we've accomplished in the last 11 or so years. And in that time, we've built a portfolio with 21 unicorns, and have done that by really building a strong network around the world. And that includes our extraordinary team, but also the more than 5,000 founders who have come to work with us, as well as the hundreds of expert mentors that make it possible to do the work that we do. Our mission is perhaps the most unique of anyone I've met in Silicon Valley and in our line of work around the world. And that is, we are trying to uplift people and economies through entrepreneurship. It's really important that we do what we do with a goal of creating thriving ecosystems, of backing people who perhaps would have been not just underestimated, but also underrepresented as well. And that goes back to our earliest days when we were one of the first international VC firms investing in emerging markets, including in India, in perhaps defiance of some of the norms and expectations of more traditional players here in Silicon Valley, where I'm based. Where we think about where we are today, we are a global innovation acceleration machine from Silicon Valley. And from the San Francisco Bay Area, and we have impact certainly in India, but also in some other important centers for innovation and entrepreneurship. Singapore, in Southern California, in the LA area, in Tokyo, Istanbul, Turkey, New York, Ho Chi Minh City, Vietnam, in Europe, in places like London, Sao Paulo, Brazil, and Mexico City, Dubai, and certainly in Southeast Asia, in Kuala Lumpur. And together, what that means is that we are running startup programs around the world. We have a flavor for what's local and then also what can be world beating. We are building ecosystems, as I said before, and key to ecosystem development is the end-to-end support of those innovation ecosystems. And then finally, corporate growth, which I take care of, is really about the enabler of strategic innovation and growth, and that is what we seek to be. So why collaborate? Why should startups and corporations get together, and why does a traditional early stage venture capital firm such as us care so much? We believe it's important because those are keys to the ecosystem, and it's when we come together that we can build the future today. A fundamental reason is that corporations need to find new growth engines. So for corporates, they need to defend some existing turf and they need to focus on some core business improvements. We all know that, and they've been doing that since the dawn of time. But what's key is to grow, need to discover and commercialize new ventures, new revenue streams, new business models, create the new markets that don't exist today. The luxury of sticking to what you know is no longer the case. And we certainly don't need to explain that to people attending this conference today. But what we do know is that building new growth engines has never been more dynamic, has never been more exciting before, because it means rapidly, potentially exponential growth, which is very different than the linear experience of most types of businesses, because it means leveraging disruptive technologies and, of course, business models. Now, startups can help enterprises find new growth and capabilities, and that happens in 3 ways. First is leveraging technologies. That means increase the quality and efficiency of core businesses by integrating novel technologies developed by startups, and we're seeing this around the world. Then there's partner on new business models. So can you create new sources of growth by deploying disruptive business models that are being refined by startups and in concert with them? And then third, adopting the business practices and capabilities. So enhancing the organization's ability to improve, iterate, and scale a business by adopting startup growth practices. And what is the startup advantage here? Why do we keep harping on startups? It's because the main job of a startup is to search for a workable business model and to find the right match between customer needs and what the company can profitably offer. And that is something that needs to be done quickly. And that is what startups are so good at, is of course moving fast, as many of the participants today understand firsthand. So what are the key trends and how do we see a changing picture? Well, we see it firsthand. Our portfolio companies, as I said, come from around the world. And what would have been unimaginable just a few years ago is that there's been a tremendous shift in terms of where they are from. There was a time when it was believed that great startups were built in and only in Silicon Valley, and then perhaps only in certain types of highly advanced ecosystems. But then those ecosystems have popped up all over the world. And as a result, we have in our own portfolio, give or take, half of the very valuable companies coming from outside of the US. In our accelerator programs, we might have 40% or more of the startups coming from outside the US. And so what we recognize is that there's been a long story of democratization of the startup ecosystem, and that ecosystem is becoming widespread and it is showing up around the world. In fact, before the pandemic, 2019 and 2018 were real watershed moments, because it was the first time when there were more unicorns outside the US than in the US. And of course, there are going to be many more to come in the future, in particular in India, where we know new unicorns are arriving every day and certainly every week. And of course, India is set to produce many decacorns, many very large growth stage companies in the next few years. So we are seeing that firsthand as investors and experiencing what that's like, because we see the rate of high growth in startups around the world. So our first important trend is more companies are creating corporate venture capital funds. There are approaching 1,000 corporate venture capital units, or CVCs, that were active investors in 2020. And that's really significant, because the last time we had this big of a recession, people thought that corporate venture capital firms were going to pull back. They were going to shut down, that corporates were going to sit on their hands. They wouldn't be investing in the startup ecosystem. And in fact, that has not proven to be the case. They did not disappear. There's some staying power, which is really interesting. Then CVC investments have grown to approximate about 1 in 4 of all the money, all the dollars, all the rupees in venture capital activity globally in 2020. And that is something that when I was beginning my career in tech a couple of decades ago, I would not have imagined that we would have seen such interest from big companies to participate, because we thought, well, venture capitalists invest and big companies acquire, or something like that later on. And certainly we're seeing a real interesting collision of those worlds. Now, those CVC creations go beyond the technology sector. What do I mean by that? You can see here some logos that are not just your Googles and Microsofts, who are certainly here as well, but very traditional industries that are now very commonplace investors, whether they are in financial services or telco or automotive or in energy. You see billions of dollars committed by these and other CVC investors into industries that they know are changing rapidly, that they recognize are on a continuum of being turned from atoms into bits, from analog to ones and zeros. And therefore, they need to place these kinds of important bets on the future. Now, we believe at 500 Startups that Indian CVCs can become major players in the local ecosystem in the years to come. It's only natural. But the question is, what's their recipe going to be for success? And there are a few key dimensions to understanding this. And this will be a journey that the right leaders will take and will understand they need to pursue to get right. And that includes, first of all, really prioritizing the types of returns you want and what you believe in. So are these strategic returns? If so, how will you measure what are strategic returns? Or alternatively, are they financial returns? And do you expect to have top performing fund financial performance? And what does it look like to get there? And the second two pieces to this recipe, or key ingredients, if you will, are thinking about the team and the culture that you would want to build in this CVC unit. Are they going to be folks that are corporate and close to the parent company, or are they going to come from the entrepreneurial ecosystem? There's a huge decision that comes in there that influences your ability to deliver on the priorities in terms of kinds of returns. And then finally, the level of integration or autonomy that will determine whether or not you get into the best deals, and then if you turn out to be a good investor. So these are like key aspects to having a good recipe for success in CVC. Next, an important trend is about human-centered design. So that is going to be at the center of new business building into the future. And why is that important? Because while we all know that the first technology products might have been introduced for a niche audience, in the future, it is going to be so important for us to be building solutions for massive markets and to people who, of course, need to experience and benefit from not just technology, but new ways of delivering value and new business models in particular. If we think internally, a new innovation of the last few years are venture studios. And I led the venture design program at the global bank BBVA, and I saw firsthand what this means. New venture studios, they are building the businesses that should exist in the world, but maybe you can't invest in or find or buy or partner with today. But it's very expensive to operate venture studios. It requires a whole lot of strategic commitment, really committed leaders to do it. And that's true across every industry and every company. And you need to find the right model and the right framework that can justify the current OpEx with big returns in the future. Because certainly committing for many, many years before you see those results requires a certain amount of both flexibility and desire to invest now for future returns. Third important trend is around business experimentation. So we all know that big companies are very good at doing things at scale, but struggle at doing things in a small way. But what we found through our work, in particular at 500 Startups, is that pilots and POCs are a key tool for business experimentation. Caveat, with the right partners. So you want to fail fast, you want to fail cheap, you want to de-risk the future investments you're going to make that are going to be key for the future of a company. And you want to build valuable businesses with startups, but the right startups. So now you're probably wondering, how do I know if I'm working with the right startups? Turns out many people are not working with the right startups. In fact, according to BCG research conducted in Europe, for example, 45% of corporates and 55% of startups are very dissatisfied or somewhat dissatisfied with their partnerships. Not a good start, is it? And why is that? It's because startups have a choice about who to work with, and you need to attract the best ones. And this is something I share often with members of the business community and remind startups, whether we've invested them or not, just folks within our network, it is really important to use their time and your runway judiciously. And so if you're a startup leader in this audience, think about who you're going to work with and under the right circumstances so that it is truly a win-win, because time is your most valuable asset. Now, if you're a big company, you're wondering, okay, fine, what do startups want? They probably just want my logo, right? Not really. The most important things that startups want, based on our research, talking to over 100 different CVC units and of course, hundreds of startups that we've invested in, is that sales and distribution support is the most important thing. That's followed by talent sourcing. It's really hard to build a great company, and can you connect good people directly or indirectly? Third is expansion to new markets and scaling. And then fourth is knowledge sharing, insights into customers and so forth. After that comes R&D support and facilities. Only then, not even in the top 5, is brand recognition and reputation, which is sometimes counterintuitive, but really important to understand in this particular way. Now, we've talked a lot about the startup ecosystem. We talked a lot about going and working with startups. I would say that's not a silver bullet. It is just one piece of a bigger puzzle. We think of it as just the fourth leg in an important set of things here we call open for. And so that includes actually having right strategic priorities. Do you have strategic intent? Then think about how you work with the startup ecosystem. After that, there's the value proposition that you design that is compelling to folks in that ecosystem. And then organizational readiness, whether it's to work with startups, to make acquisitions, to make investments, and internally to build the right businesses that you should be in. So I want to leave you all with some important takeaways. First of all, that corporates will need to innovate like a VC in the future. That is, build a portfolio and employ a toolkit of open innovation tools. Startups here should look for companies that want them to be successful. Now, this sounds kind of obvious, but really determining who is a good partner, who is looking to build something together and co-create, not just look at the startup as outsourced engineering, or look at the startup as a way to just get a bunch of ideas, but not really build anything. And so the right practices and the right discipline are going to be beneficial for that corporate, but also for the startups, not to look at the world suspiciously, but to understand, is this a corporate partner with whom my values and, of course, our long-term strategic intent, and I can tell their long-term strategic intent is a fit. Because while the future is unknown, it is going to depend a lot on collaboration. The past was all about ruthless competition, but what we know is that in a world where we all own different parts of a value chain and of these different parts of the economy, we need to collaborate to win. I want to end by saying this is only the beginning. This is a number of events and trends that are important, but are going to manifest in even greater ways in the future. And so it's a great opportunity for everyone here to think about how they're going to get the most out of the day, because things are just going to get started now, and we'll see it more pronounced over this next decade. It should be roaring 20s for those who are creating, building, and designing. So good luck, and look forward to seeing you all do something great. Thank you.
Navyug, you're on mute.
Thank you, Vijay. Super start for the day. Perspective for what's to come. And I would even go forward and say not just perspective, but a wake-up call. And if 1 in 4 dollars, investment dollars, are already coming from corporations which are not looking at this, I think need to start looking at how they want to accelerate their innovation journeys. The world's doing it. And startups who are always eager to grow and scale and are chasing funding with venture capitalists, I think are very well served, as you so clearly and lucidly brought out, and the numbers do the talking, by working with corporations. So thank you. I think this sets context. Now, Vijay, for the few minutes we have, a few questions came to mind. Now, one of the things I'm seeing here in India is a lot, and this is not for all, and it's wrong to generalize, but I see a lot of people, corporations are doing, pilots and POCs with startups, largely for marketing and PR, and just to signal that they're serious about innovation. And then obviously you don't get the outcomes that you want. So what would be your advice, and how does one cross this chasm and move into a more serious engagement?
Yeah, I'm really glad you brought that up. Thank you, Navi, again. I think when you are inside a big company, you've been told to go and do something and start an ecosystem. It's very overwhelming. You just go out and you kind of meet the first startup you bump into, and you try and make something work together. And instead, I would encourage people to take a much more strategic approach. Think about who do we want, and of course, develop, instead of an ad hoc system of meeting people in the ecosystem and forming partnerships and setting up your lab, can you create a pipeline of a few prospects that you really want to work with, and then have a value proposition for them. So this is very counterintuitive for big companies. The idea of looking at the startup as their customer and thinking, what do I need in a value proposition? There's actually like 4 important things that you need to have. You need to think about the key things that we identified in that list. So how can I help you accelerate sales? How can I provide you access to data? What like technical resources and R&D might you have? And then the fourth important area is, do we have any other type of, know-how or business or subject matter like help that can help the company get to the next level? A lot of big companies might say, "Oh, we'll set up a space. We have a few desks here. That'll be fun. They'll come and work." Or maybe some other types of events and things that are a lot of fun and may like be an interesting first start, but really asking what would the startup need from us if we were to put ourselves in the shoes of them is really important. And so I think as in talking to you and others in the past, having a sense of empathy is really important for them.
Yes, and I think you've again there was a key point in there, and that corporations need to sell this and be attractive to startups. And the general perception is where startups need to sell it, and I think both need each other. And while startups want a great partner, they need to be attractive. I think the message that I want to underscore is that corporates need to be attractive to startups, and not perhaps take this approach of, hey, we're going to pay you or perhaps invest in you. And they're competing for as they do for talent, they're also competing for good startups. So
absolutely.
And I think that's something, in the interest of time, we can't get into details, but I think guidance on what corporates need to do right to attract the best startups is just so important. The other point I want to draw your attention to, Vijay, is often corporates will go into this journey without doing upfront work in problem framing or challenge identification. What's your views on that? Because that first piece of really deciding, and a question which is related to that is, should corporates look at near-term horizon projects, horizon 1 and 2, or should they work with startups for the far horizon, super disruptive new stuff? What should be their strategy or approach?
It's a really interesting frame, and thanks for also like teeing up. Yeah, is this horizon 1 or horizon 3? Things that are in horizon 1, the core business needs to solve those problems, and it needs to like have a way of thinking, oh, these are as the literature would suggest, incremental and sustaining innovations that we have to make in order to satisfy our customers in the next 12 months. We don't have the luxury of going and running an experiment with a startup. So startups are often therefore better partners for Horizon 2, where you might be moving into a new market, or Horizon 3, where you recognize there could be disruptive technologies and whole new customer segments that are opened up by disruptive business models or technologies. It can be sometimes that a later stage growth startup that is effectively the size of a mature company in terms of its turnover and capitalization and things like that, but we're still calling a startup because it's relatively young. Those companies are sometimes great Horizon 2 partners, and you can go straight into a commercial agreement with them or something like that. Of course, there are examples of M&A activity as well. But asking ourselves how to be bold and how can we think about how to build, buy, partner, and invest in collaboration with startups for Horizon 3 is probably your best bet.
Yeah, I agree. No, that's wonderful, and I think these are choices, and it's very contextual. So that's very helpful. And very quickly, Vijay, at what point do you think corporates need to go from POCs to pilots to production? And that's one bit. And then they set up corporate venture capital. There's an inflection point there where they're no longer doing experiments, but they're now going all in and setting up corporate venture capital. So in your experience, is there some inflection point or some signal?
Yes, that's great. I noticed that a lot of companies were making acquisitions, and then they started making investments, but then they found their corporate development teams weren't very good at making small investments. Like they might be good at buying a $1 billion company, but not a group of 10 developers and a few salespeople who are in a garage somewhere. And so that takes a different mindset. And so then they build out the investing capacity. But then after building out the investing capacity, they say, okay, now we would like to start building and figuring out how to partner. I think in the POC activities that occur, imagine a POC or a partnership or a pilot of some kind as a way to de-risk and validate to you the value of what this business is. And at that point, you want to invest, not because you want to control the business. Oftentimes, many of the top investors I talk to tell me, like, actually, we don't want a board seat, or we only want an observer seat. We don't want to influence the company because we want it to be successful and want you to be successful, as I said earlier. Instead, they are saying, this is something that has value. We've helped it have value. We've de-risked it in our own minds. And now we want to participate in the upside as investors. And so I think that is the right sort of mindset in which to go from POC to shareholder.
Thank you, Vijay. And I can go on and on to dip into your experience. And we've run out of time. I'm just going to quote this study from Mind the Bridge. And they were talking about corporate startups. And one of the imperatives they had, or they said, based on their research, was you have to have an outpost in Silicon Valley and Israel. Having that is a must. We need to add India to that list, given our startup ecosystem. We hope that 500 startups will help accelerate India's journey. We are just an amazing high energy, and like you said, a large corporate with a large startup ecosystem, unique combination. So we're really delighted that 500 startups is going to be very active in India. Good luck to you, and thank you so much for taking this time off. I know it's a whole different time zone, so thank you very much, and look forward to having more interactions and your participation in the Indian ecosystem.
Great pleasure, honored to be here, and thank you again, Navyug.
Thank you, Vijay. Thank you very much.